At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Hi, this is Glen,
And I'm Scott.
and today we are here to chat with you about lifetime income potential.
And what does that mean?
How much money could we actually have through our lifetime?
Right. So between now and say age 65, we are going to work, exchange hours for money, right?
Definitely.
As Robert Kiyosaki would say, we exchange hours for money. So we want to look at from whatever age you are today to age 65, how much money is actually going to fall through your fingers and how much of that can we actually recapture. So we want to get into the software to walk you through the mechanics. And as we go through it, you're really going to start to understand all of the wealth transfers that are going to happen in your financial life between now and you turn age 65. So with that, is it okay if I get into the software, Glenn?
Let's get into it.
Perfect. So here we have the software that's going to show us what our wealth and income potential is. So I'm going to use you as the guinea pig to tell me, for our hypothetical client, what's their current age?
Okay, let's say age 40.
40. And retiring at what age?
We're going to go with the typical 65.
Perfect. Now, this 40-year-old is currently earning how much money?
I like that round number. Let's go to 100 grand.
Okay. Now, hopefully, over the next 25 years, this individual is going to have an increase in income, whether it's inflation, 1%, 2%. What income growth percentage would you like to put in there?
Let's go with, let's give them a 3% income growth.
Nice. Must work for the government. Ooh, sorry, I shouldn't have said that. Now, do we want to put in current savings, or do we just want to focus in on how much income they're actually going to have?
Let's just go with the income for now.
Okay. So therefore, we do not need to worry about a rate of return.
No, not at this time.
So if we look at this simply, we have 25 years at $100,000 a year. Simple math would say, well, that's $2.5 million. But remember, we are increasing that income by 3% a year. So the total amount of money that this person is going to receive, exchanging their hours of work for income, is $3.6 million. Now, I have a question to you. If you were working for an employer who said, I will pay you $3.6 million today and not another penny for the next 25 years, and you had to work there for that 25-year period, if the $3.6 million was all the money that you were ever going to have, would you be more conservative with that dollar amount to ensure that it'll last you until retirement?
That is a definite yes, because there's nothing else coming.
Exactly.
Okay.
Because now you can see the fruit of your labor, $3.6 million. The problem is that comes to us every 2 weeks in small, little bite-sized amounts of money. And because we see it reduced to the ridiculous, there are so many flashy things vying for our dollar to spend. And we end up not really realizing our true economic potential over the next 25 years. So if we could become aware of where all that money is disappearing to, because definitely this person is not going to have $3.6 million by the time they cross their retirement finish line, because there are things called wealth transfers. And these are the silent killers that are taking money away from you and jeopardizing your future. So those wealth transfers, the three biggest: taxes, debt servicing, and lifestyle. So if we were able, in a perfect world, to earn $3.6 million and not pay any tax, that would be pretty sweet, wouldn't it?
That would be fantastic.
But I'm not sure if any of you aren't aware, there's an institute called the Fraser Institute. Every year they put out a report on the economic viability of the average Canadian. Now, the average Canadian makes $89,000 a year. Based on $89,000 of income, Glen, what do you think their total amount of taxes from all sources is as a percentage? Not just income tax.
I'm going to say about 40%.
It's actually 43. Now, for you out there going, well, hang on a second. There's no way this person's paying 43% in income tax. You're absolutely right. It's all taxes. We have our HST, GST. We have gas tax. We have sin tax. We have payroll tax. We have healthcare tax. We have tax on tax, gas tax. All of those taxes add onto the amount of income tax to equal 43%. Now, the funny thing is, the more we spend on debt servicing and lifestyle, the more tax we pay. Who wants to pay more tax? But as we buy more things, we inadvertently pass on more money to the government and less to ourselves. So on $100,000 of income, what amount of tax would you like me to put in for this individual?
Well, you know what? Since 43 is what is said, let's go with the 43.
Perfect. So now, taxes are inevitable. And if we understand that we're going to pay tax regardless, let's leave it at 43 for now. So if we're paying 43% of our money to tax, then that $3.5 million drops down to $2 million. Now, on top of paying tax, this 40-year-old likely has a mortgage, car loans, credit card debt, line of credit, etc. What percentage of their after-tax income, because now we've just paid tax to the government, we can only spend the money that we have, not the money that we have gross. This is the net amount. What percentage of their lifestyle leftover income goes to cover off debt?
Well, if they've got a mortgage, let's run it about 30%.
30%. So now we have just transferred away $2.6 million to two entities. We had 3.6. Now we only have $984,000 out of that 3.6 million. How do you feel?
Really depressed.
But it gets worse. We have to live on lifestyle. So what do you think the average Canadian saves as a percentage, or at least should?
Oh, we hear 10% talked about a lot.
Okay.
Right.
So if we have 27% left over, our lifestyle is now 17%. So all this money is going out to everybody else. And for simple math, that is 90%, 90, of the money that you work for is leaving your bank and going to somebody else's, isn't it?
That is truly depressing, Scott, but yes.
So we are led to believe in traditional financial planning to allocate, if we can, 10% of our money to ourselves. And somehow we believe it's okay to flush the other 90% down the toilet. Where did that become traditional, logical financial planning advice?
Well, it certainly is traditional. When we put it this way, logical, maybe not, but it has been traditional advice.
Exactly. So Do you remember the total amount of money we had before we started losing all of this money to everybody else?
We had $3.6 million.
Exactly. Now let's take a look at how much money we actually have for our retirement. $365,000.
Woo!
That's it. This chart shows how much money you are transferring away in those wealth transfers, these three, to everybody else and not to yourself. Now, I know I can hear you screaming at us through your computer. That is just a fact of life. And I'm going to tell you, until we understood how infinite banking works, I would agree with you. But these are wealth transfers that you have the ability to control. And if we can recapture percentages of not only debt servicing, where you can take over control of your own debt, but also lifestyle, where we can show you how lifestyle expenses can be turned around by making one small change in your financial DNA, we can have money stop flowing away from you and start flowing back to you. So now, if we could start pulling back some money, Glen, let's assume we can't do anything with taxation, because that's always going to be putting their hand in our pocket. If we could start recapturing and becoming your own bank, what percentage of debt servicing do you think we could recapture?
You know, I'm going to be ambitious on this one. I'm going to say about 10%.
So we'll drop this down to 20, right? Now, am I telling you not to go into debt?
No, you're not.
No, the debt's still there. The question is, who controls it? Right now, you've lost all control because your debt's held by everybody else's bank. Whereas we're going to show you how to pull your debt into your own bank. So now if we can recapture some of that, we go from $365,000 to $729,000. We doubled the amount of money we have for retirement. Did I ask you to work any harder?
You did not.
Did I ask you to take on any more risk?
I didn't hear any of that.
Did I ask you to get a second job so you have more money to deposit for your future?
Thankfully, no.
This was 100% of the money that you had. You just weren't aware of how to have the money come back towards you, were you?
No, was not aware that was possible.
Now, if we are going to spend money on lifestyle, Netflix, our home renovations or property taxes, if we're going to spend that money, then if there's a way that we could start to recapture some of the lost opportunity costs, because when you transfer that money away, it'll never be there again for you to make money. And we are showing you this here, that as that money is transferred away, $2.5, $3+ million is gone forever. So if we focus on lifestyle, and you're still spending the money that you're spending, but we're able to recapture the lost opportunity costs, how much do you want to reduce the loss in lifestyle?
Scott, if that is possible, I want to know now, and I want to know badly how we can get this done. So please.
And
continue.
that will be another video. Tune in next week. So how much shall we reduce the lifestyle by? Not telling you to go on a budget.
Mm-hmm.
You're still spending the money. You're just not understanding how to recapture it.
You know what? Let's take a 5% chunk out of that.
So now, we're still paying taxes. We're still paying debt. We're still going out to dinner, paying our bills, etc. That same dollar amount that came in, the $3.6 million, we're now just starting to teach you that there is a better way to start to recapture this money. If we apply these changes, we went from $365,000 to $900,000.
Scott,
There's no risk in this.
I'm starting to feel a whole lot better, Scott.
So now, let's assume that there was a rate of return. So let's put in an amount of savings for this 40-year-old. We're going to make this really juicy now. So how much has this person saved so far?
Well, I mean, right here we've got, are we talking dollars? Let's see, current
Dollars.
savings. We've got about, let's say we got about $80,000.
$80,000.
Mm.
So this is now going to add to the amount of savings. Pretty simple. $991,000 of total money now for the future. But they're going to invest that money. So they're looking for a rate of return. What rate of return would be a realistic rate of return for this person?
Well, you know, considering this year, I've been hearing some double digits, but let's really go with about 6% long-term average, I'd say.
Okay. So there's something that's interesting that's going to happen here. I want you to pay attention to both of these numbers down here, the 991,000 and the 2.7 million. And I want you to see if you can pick out what just happened when I apply the changes.
Well, I'm feeling better and better, Scott. And on my 900,000 is now 2.284 million. However,
Yes.
that number beside it is really glaring. That 5.84 is huge, or 5.82 is huge.
Why would the money spent, the money lost, the wealth transfers, why would they go up when we apply a rate of return?
Well, at the end of the day,
Why wouldn't it just be the rate? Why would it just be the investments, the total money, the savings that goes up by the 6%?
well, we know that money doesn't just stay dead. So if we're making money on our end, we have to assume that money's being made on the other end as well.
Exactly. If we're transferring this money away to all of the other entities, they don't let it just sit in a drawer gathering dust. They put it to work. So if our hypothetical 40-year-old could earn 6% on their money, then there's every likelihood that whoever we transfer all of that money to would do the same thing with our money and make money off of it. So this is showing that the more money we transfer away, the less we're going to have. And if we can just recapture, all we did was show you how to recapture money. And if we go back to these numbers the way they were, saving 10, we dropped from $2.3 million to $1.1 million.
That's depressing, Scott.
Current financial planning has us focused on the wrong problem. We're focused on how do we grow our savings. With infinite banking, we show you how to focus on the money that you're losing, so that when we recapture these, now, I've actually forgot what your numbers were, Glenn. Was this 20? I think it was 20.
We had 20, yeah. We had 20 there.
Yeah.
There we go.
So without taking on any extra risk, we just increase the amount of money that you have potentially crossing the retirement finish line by 100%. We doubled it. And we're not telling you to take on any more risk, and we're not telling you to invest any more money. Just recapture parts of the wealth transfers, that 90% that is going away to everybody else. Let's start pulling some of the money back in and using it for ourselves. And if we do that, we make ourselves wealthy instead of everybody else.
I love that idea. And with no extra risk or no extra out-of-pocket costs, I'm liking that whole redirection.
And what I'm offering to everybody watching the video, if you want us to do this for your specific situation, leave us a note in the comments section. Hit us up on social media. Let us know what you're thinking about this, and we will run this specifically for you and give you a copy of it so you can understand, if you start to implement infinite banking, what the potentials are for your unique situation.
And I can imagine those of you out there looking at this going, if that is possible, which it is, this is something we need to learn some more about, which you need to. So as Scott said, contact us and we can give you a customized worksheet of your own situation so you can see what your potential is without taking on any more risk.
Exactly. That is not how you plan for retirement. I remember reading a quote once, and it could just be one of these, did it really exist quotes. But the wealthy say, if you want to be wealthy, stop transferring away your money to everybody else. It's really that simple. And this shows you exactly how, if you can stop transferring money away to people, you allow it to stay back in your own banking system. And what better place to have your money under your control instead of somebody else's? Wouldn't you agree?
I would 100% agree.
So there you have it. Wealth and income potential. How do we recapture money that we're currently transferring away to everybody else? I often tell clients, traditional financial planning is like an iceberg. They have you focused on the 10% that you can see, but the danger is in the 90% that hides behind us under the surface. And if we can become aware of that, then we can navigate and start to recapture all of that lost money. I do this for every single client to get them to understand what their real potential is and how much money they're actually going to be losing if we continue the traditional narrative of how financial planning should be done compared to implementing infinite banking to start recapturing that money. What do your clients say when you show them this?
Mind blown. It's a shift. It's all about rethinking your thinking, and it is such a huge mental shift, right? That they, sometimes they go, "This can't be real," and we go, "It is," and you're going to learn how.
We always tell people that our main job is to get you to understand the problems you're not even aware of. And then once you are aware of that, then we can engineer the solution. And this is a very big one, as one of the first stepping stones in your education on infinite banking as to where the money is going so we can start to pull it back. So if you like this video, as Glenn said earlier on, subscribe to the channel, hit us up on social media, hit that bell. More videos come out, at least 2 a week, and leave a comment in the section below and reach out to us if you want us to do a customized wealth and income potential for yourself. Anything you wanted to add to this before we sign off?
There's a question asked a lot, and especially in our circles, is if everything you knew about money was not really so, when would you want to find out? Now?
Oh, I know.
Or later?
Now.
Now would make more sense, because finding out how this can work in your situation, again, not a hypothetical, in your situation, gives you the time to course correct and make yourself and your family be the beneficiaries of some of this money that's just going out the window that we don't even think about while we sit and worry about how to make more off the 10%, which we have to take on more risk to do.
Exactly.
Right? So, yes.
Yep.
Contact us, subscribe, leave some comments, and we look forward to showing you how you can do this too.
IBCanada Group, your independent authority for information on the infinite banking concept.